The Facebook IPO. Have you had enough yet of the Facebook IPO? Probably you have, but no, it's not enough. Rolf Winkler of Heard on the Street is here. Rolf, you had a piece out.
I did have a piece out.
It turns out a lot of people are going to cash in some of their chips.
Yeah, you got a lot of VCs who are going to sell 20-23%. If the green shoe, the over-allotment option, is exercised, a whole bunch of them will be selling as much as 23% of the stock, which is a lot more than VCs sold in some previous tech IPOs.
Right. Now, there doesn't seem to be any question, if you will, in the marketplace that the IPO will be a quote-unquote success. And why do I say that? You know, the sentiment is you have to own this thing no matter what the price is. So the IPO will be a success. The question isn't whether or not you try and get an allocation of the IPO, because everybody will be fighting to get those and we'll have to cut back plenty of people. The question is going to be, do you buy the stock in the aftermarket? That's the question.
If underwriters do their job and get the stock to pop above 100 billion, let's be honest, that's where they want to go.
Is that what they're supposed? Is that what their job is?
Isn't their job to maximize the value? You tell me, Newmark. If this thing does not get above 96 billion, which is the high end of the target range, will that be viewed as a success?
I don't. I mean, who cares? I mean, they're still selling stock at 100 times earnings. You know, a company whose revenue quarter over quarter was flat.
You're asking whether you buy it. Your first crack at it is going to be probably above $100 billion. If history is any guide, this thing's going to trade down. The excitement will fade, right? Early on. Even LinkedIn.
So, on the first day?
Let's take, not necessarily, but you don't have to buy it on the first day, right? Take LinkedIn. That's the one of the recent crop of IPOs. They've all come at pretty big valuations. The interesting thing about LinkedIn is the business itself is interesting, right? Now, that's not true with Groupon.
The guys at Groupon and Zynga would tell you that their businesses are interesting.
Of course, they would tell you that, but we would disagree with them, right? LinkedIn is, for me, a more fundamentally a business that can last, as is Facebook, right? Even so, even with LinkedIn, that thing popped up to above $120 a share on the first day. Did you have to buy it? No, it got down, I want to say, into the 60s, right?
Well, LinkedIn, yeah.
But of course, today we're seeing it's coming close. It's touching on a day the Dow's down over 100. It's getting back to 120.
Right, which is where it was trading that first day.
I'm not saying Facebook's going to do exactly that, but I'm saying you're probably going to get an opportunity back below wherever it pops on day one.
Right. If you're an investor, how do you look at this? Don't you look at this as I could buy Facebook?
I look at it as taking a flyer. I look at it as
taking a flyer. A flyer is something you take when the stock has a reasonable chance of doubling or tripling. Do you think that Facebook will double or triple in the 3 to 5 year time span? Are we talking about a $300 billion company?
If you can get it, if this valuation comes back down to 60, 65, 65 billion, yeah, I think you could get it. You could get a tripling.
Right. What if it's at 100 billion?
What if it's at
worth $300 billion?
No, you don't buy it above 100 billion. No. But here's the thing that investors have to remember: they made $3.7 billion of revenue last year. Have you ever actually clicked on a Facebook ad?
No.
No. They're awful.
I don't even have a Facebook account.
The advertising experience, here's the thing, the advertising experience on Facebook today is terrible. And they still make $3.4 billion or whatever of advertising, right? They're just turning on some of the more interesting things that are going to happen.
That is
right. They're putting ads into the news feed. They're making them more interesting.
But that's what you would call.
That's why you take the flyer.
That's what you call a half cup full argument, though. The half cup empty argument would be.
It's not a value stock. You're not pretending this is a value stock.
The company's been around for a long time, and the most they've monetized as growth slows is $3.7 billion. That would be the half cup empty argument. Your cup is always full. Your cup always runneth over, Rolf Winkler, especially when it comes to these social media stocks.
You still think I was long Groupon, huh?
Yeah, no, you know, I'm not that hard on you. But I will just first disclaimer: my wife does work at Google. But I think for anybody who's buying a stock that has a $100 billion valuation, you better think twice.
Google's got a $200 billion valuation, but you'd buy that one, wouldn't you?
Google has $50 billion of cash on its balance sheet and trades at probably 15 times after cash earnings. This company's trading 100 times earnings, right? Big difference.
Big difference.
Is there a
lot more growth there?
Stay tuned. May 18th. Did I get that day right? May 18th is pricing.